case, I would like to move on towards the more practical parts. So to make it very concrete, we decided to work with a very specific scenario. So imagine you have a customer, John, or you have a female customer, Judith, and they go to, for example, Amazon to purchase a fancy TV online. And while she is in the process of paying for the product, she is offered a loan, consumer credit loan. So it basically means that she is automatically scored by a consumer credit scoring application. Why is that possible? Because the company, in this case, for example, Amazon, has a partnership with the bank of that customer. So in that case, we can, the company Amazon could actually automatically score John and Judith on their credit worth using the AI solution, and then deciding whether they should get a loan, yes or no. So this puts us a little bit in the context of automatic credit approval, e-commerce setting, and obviously consumer credits. To make it even more specific, we thought it might make sense to provide you with an example data set. It's not that you cannot discuss outside of the data set, but it's probably more easy to think of the specific data set. So basically, what you can see here is the German credit risk data set. I think some of you might be very familiar with that data set. It's, we have chosen for a snapshot of the data set. So originally it has 20 variables. In this case, it only has 9 predictors, and the 10th is obviously the credit worthiness of the person. So basically every line in the data set is a customer for which we try to assess whether it's a good or bad credit risk. And in terms of profiling behavior, profiling variables, we have the customer's age, sex, their job, their housing. Then we have 2 variables on their current financial situation. So in terms of how much money they have on their savings accounts, and also how much money they have on their checkings accounts. And finally, the last 3 variables pertain to the credits they are applying for. So the credit amount, the duration, and also what specific the purposes of that credit they are applying for. So the objective of the entire World Café is actually that we end up with something that looks like this. So if you're familiar with the CRISP data mining process, it actually tries to show you what are the different steps in a typical data mining project or an AI project. Starting from the business understanding, which would mean in this case to really understand the consumer credit use case. Moving on to data understanding, where the data scientist would actually try to understand, okay, what is the data that I need to solve this business problem? What is the quality of the data? Do we have a lot of missing values? All that kind of things, which leads to data preparation, where the data scientist would build some metrics, would perhaps do some transformations as well, leading to the modeling phase, where we would build the credit scoring model, taking in mind the variables that have been created there. So there's like a continuous loop here. And then after several credit scoring models have been developed, typically you will evaluate them, not only from a mathematical point of view, but also in combination with business. So that's why we also have the arrow to the business understanding. And finally, after the evaluation, typically one model is selected to be deployed. And that's actually the final solution that is then implemented and monitored. And after time, we can update that model again. What I would like us to think, to do actually, is actually to first define the business understanding. That's the first café. And in the next café, we will look into the different and the other phases of what we should think of, or what we should do in order to implement the consumer credit use case in a more ethical and trustworthy way. But let's first start with the first business café. So given your expertise, so I tried to assess your expertise and allocate you to the right group as much as possible. But given that you are a legal expert, a credit scoring expert, communication expert, or an ethical expert, we have created specific key questions. And the answers to these key questions should help us to define the business understanding.
We kind of freewheeled a bit on some topics. So the first question was, who are the stakeholders of the consumer credit? How much time do you have to debrief, Anita? Just to make
I would
sure.
say everybody gets like 3 minutes.
Okay. So then I'll immediately zoom to the most important ones. I'll immediately zoom to the bottom 3 lines because I think those are the most important ones. Can we discriminate based upon gender? All of us said no. I can say that from an analytical perspective, gender is the most important piece of information in any analytical exercise. Men and women are different when it comes to fraud risk, churn risk, credit scoring risk, etc. So, but we all agree we cannot discriminate. A little bit more tricky was, can we discriminate based on age? Age is a very important discriminator in credit scoring. Older people are more creditworthy than younger people. So if we discriminate based on age, that should be factored in through the risk, because banks are obviously doing risk-based pricing. But society also has a role to play in there. To my colleague members that participated, if I summarize it wrongly, just let me know. Society has a role to play in there because we should also make sure that younger people get access to credit at decent conditions, such that they're given opportunities and so on. So that's really very important. And then we also said, like, when you talk about discrimination, it has 2 meanings. It has a data science meaning, like you discriminate between good and bad payers, and obviously there's a legal interpretation. And we finished off very briefly, but very interestingly, with a very short piece of information. Can we use your mobile phone data for in credit scoring? I'm sure that everybody immediately says, no, you stay off my mobile phone data. I don't want you to use my mobile phone data in credit scoring. But yet, a recent piece of research that I conducted myself showed that who you call is often situated in your economic circle. And it's very important to know that for credit scoring. Why would you want to do that? You would want to do that for minorities and for immigrants and young people, to give them just access to credit. So actually, mobile phone data could be a very interesting source also as well. For credit scoring and for doing credit scoring discrimination. But it's a sensitive topic. But you can see that point we wanted to make with that is that things that sounds privacy intrusive at first sight doesn't always have to be privacy intrusive. Can also give opportunities. That's in a nutshell.
Okay, thanks, Bart. Then I give the floor to Brahim. I hope you enjoyed your legal cafe as well. I'm gonna stop share and so you can share your results.
Okay, great. Okay. I've lost track of the right screen. There it is. Okay, so we enjoyed the talk. There was one difficulty, was that we were with 3 legal experts, all 3 from different jurisdictions, quite different jurisdictions. So we more made like a comparative analysis than really being able to delve each from our own expertise into the topic. Also because our main expertise seemed to relate in IP, IT, contracting, online and innovation. So there was no, for instance, there was no specific banking regulation information present. We all had some knowledge of consumer law and other regulation. And so actually we really discussed a very long time the first question, as you can see, which made us almost forget the other questions. But I was able to fill some out based on what we discussed during the break. So to get to the point, in any of the jurisdictions, so it was United States, Australia, and Belgium, the EU. There is some kind of transparency requirement where you would have, of course, to inform the consumer about the ins and outs of the loan he would be granted. But of course, as expected, this would be much requirements would be much higher in the EU than they would be, for instance, in the US. Even though that in the US it can change from state to state, where the federal law there are some consumer credit protection laws, but they can be much more restrictive on a state level, which is also the case in some states. Australia seemed to form in many forms the intermediate, even though it's leaned more towards the US than towards the EU approach. So information is important. There's also the privacy legislation. Of course, in the EU and in Belgium, you have the GDPR, whereas in the US, you have in some states more restrictive privacy laws. And in Australia, you also have a privacy law, but which is not as restrictive to compared to the EU, but where you also would require consent, if I understood it well. And you would also have to prove that to be able to use the personal data to be allowed to be able to do the credit scoring, you would have to be able to prove that it was an informed consent, which complies with the requirements for such a consent. Mm-hmm. Yeah, there are a few other requirements, but to stay within my 3 minutes, I will jump to which actual constraints result from this legislation, these laws. So anyway, there are specific protected classes in any of the jurisdictions, and they would have to be protected. Question there was in the German data set, there was also gender was requested. If gender could be used to diversify between men and women, and all three seem to be of the opinion that in their jurisdiction it could happen, but in theory it shouldn't happen. Even though that I know that in Belgium, for instance, if you diversify insurance contracts, you can take gender into account, but it may be different when it goes about the credit. So you cannot also of course you cannot ask specific information, but because we have the German data sets, we already know what information is asked. Transparency is an issue, specific requirements, so you should have online information that is clearly visible to the person who is accepting the loan. In the EU specifically, you should follow a process in which, for instance, you first give the information, you get informed, and then in the end you must have an overview or what you're going to buy and what you will be financed at what conditions, and only upon confirmation the loan will be effective. Another requirement is also, because the agreement is entered into online, is that the agreement would be sent by mail or by another means, but on a sustainable carrier to the consumer, for him to be able to save and review afterwards the agreement. Mm-hmm. Also in Europe, you have a right to revoke the agreement, the loan, if you do not use it instantly. Then you can revoke it up to 2 weeks. But here, of course, the TV is bought immediately, so the consumer has to be informed that he will not be able to revoke it, and that he understands that this right will not be applicable. But it has to be set, because if it's not set, then if he's not informed about that, he could try to apply it anyway, and then there is discussion about the fact what this would do with the loan. Mm-hmm. Yeah, then of course, to verify the credit information itself, EU and Australia would need the privacy legislation. You would have to have access. Probably in EU would be that consent should be voluntary and cannot have any negative consequence if you do not give it. So denying the credit if there is no consent given for this kind of information could be debatable, even though that we could argue here that this consent or this information is required for the data subject to enter into the contract. So there is a possibility that they should be obliged to allow access to third-party information. But of course the consent can be withdrawn, but then of course the loan can be withdrawn also if it's not granted yet.
Okay, I think that's shedding some new light, indeed, especially with regard to buying the television and still have the right to cancel your loan. That's kind of funny.
Yeah, that would not be possible in the end, because the television is bought, even though that's not from a financial law perspective. If you buy a television online, you also have right to revoke it. And if you buy something online, a good, you're always allowed to revoke it for 2 weeks. So in this case, you would not be allowed anymore to revoke the loan. The television would be delivered. If you would revoke the purchase of a television, then the loan would be revocable too.
Okay. Okay, thanks. Caroline, I give the floor to you. Could you put your answers to your questions? You just can go into your Excel, Caroline.
Shall I share my screen, or can I just go through them?
You can share your screen. I think, Brahim, you will have to stop sharing your screen. Caroline can do so.
So yes, we went through three questions. I still cannot share my screen, but
no, I can't find.
So what are the explainability requirements for the customer and also for the other stakeholders in this specific case? So you want to buy a TV, and then you get this decision. It's binary, it's yes or no. You should be able to explain which factors were most decisive for this decision. And it should be clear, but also instead of just giving the 0 and 1, it would be very helpful for the customer, but also for the retailer who wants to close the deal, who wants to make the sale happen, to give this, to let actually the customer see whether by changing the amount requested or the duration of the payment, whether that can shift the decision from a no to a yes. So let's say it's 1,000 euros instead of 3,000 euros, and then yes, we can close the deal, we can sell the TV. Apart from explaining what made the decision going to a yes or a no, it should also be helpful to give some extra information there, both for the customer but also for the retailer. That's very interesting. And then finally the question, now I can share my screen.
Yeah, no, you can share.
Yeah.
Brian's sharing, sorry.
Okay, so here I pasted it. So indeed, the fairness, gender and age, we didn't consider them as being fair. But also, if you look at payment history as an indicator, you should also look into a certain amount of time, because maybe somebody is already in his 50s and maybe had a difficult period in his 20s. So you should not have that haunting a person forever in order to get a credit, or certainly not a credit for a minimal purchase like a TV. What I also find,
Caroline,
yes,
can I ask you a question? Because age is not allowed, for example, in the US, but what many American banks do, and I would like to hear your thoughts on that, is they do not include age in their credit scorecards, but they include time, number of years since the client has been with us, which is obviously highly correlated to age. Do you have any thoughts on that?
Yeah, we were also considering that, because of course age is also related to the amount of data you have.
Yeah.
So that is also why you should put a limit on that in terms of how many years. But of course, yeah, if you're only 1 year client and the limit is on 5 years, then maybe that's also correlated with your, but that's also one of the reasons of putting a limit. Otherwise, it can also be correlated with age. What I also was thinking myself when looking at from a user perspective, and how users also want to customize the use of such systems, and maybe also want to self-regulate their behavior. We know, for example, that some people regret purchases or maybe are more vulnerable to impulse buying the later it gets in the evening, whether they might be able to make the decision more stricter related to the time when they are making the purchase. So maybe I'm interested, I know from myself that I always buy too much when I'm finished my job and every evening I start buying. Or maybe I do want the system to be stricter then, or maybe to discourage some purchases. So that could also be something that that gives more power to the customer, and as such also creates more satisfaction amongst customers in the end. So we also briefly discussed that option.
Okay.
That's an interesting concept, Caroline.
That's a very interesting point, I think. Yeah.
Yeah, and I think I can agree to that. If it's like in the weekends and it's late and you're somehow ending up surfing different websites, you might end up buying more than you usually do. So I'm not really in the trouble financial wise, but I can imagine if you're in trouble financial wise, you might accept that kind of consumer credits and then get the results of that later. Okay, I'm gonna share my screen. Caroline, can you stop sharing your screen, please? So I had an interesting discussion also together with Frank and Koen. So let's share my screen. Just have to go to the presentation. 1 second. I think I pasted in there. Okay, there we are. So we touched upon 3 different questions. The first one is actually what are the relevant ethical KPIs when it comes to a use case such as consumer credit scoring. We thought obviously it's very important to be transparent, knowing why a certain decision to deny typically we are more interested in having some transparency on how the system decided to deny a certain loan or to give it at different terms. So it's not only from the fact that typical banks have to defend their credit scoring policy to government and national bank, but it's also fair towards customers to be transparent as to what were the main drivers, the main reasons, or the main logic of your scoring system to decide whether you would get the consumer credit, yes or no, but also which terms, obviously. The second ethical KPI pertains to explainability. It's a kind of tricky thing we experienced because on the one hand, you want to explain, for example, if you would have had 200 euros more on your savings account, you would have been given the credits, the consumer credits. But on the other hand, if you give too much details, it might be that it's making the system vulnerable to data input attacks. So people might want to trick the system by changing their the amount they have on their savings accounts and getting it up by 200. The second thing that was brought up to is that there's the whole issue that there should be some consistency in the explanation. And that consistency of explanation might be at risk when, for example, banks are merging together. That might result in a situation where the customer gets a loan at a certain moment in time. They apply later after the merger of the banks again for a similar loan. Their conditions didn't change at all, but because the new credit scoring policy is more strict, more conservative, all of a sudden the same customer is no longer granted the loan. So that's a kind of difficult from a human perspective to understand what happened there, because the personal situation didn't change that much. You ask for a similar loan and still you don't get the loan at this moment in time. Also, it's important when you think about ethical KPIs, if you define, you don't want to discriminate, that you define very well which groups you want to monitor. you want to not discriminate on. And we also said that, Koen said that it's very important to also monitor the group unfairness over time, even more so than the current situation. So that's something to keep in mind. Next question then. So when is a consumer credit allocation deemed unfair with regard to an individual or a certain group? Well, I found a very interesting statement by Koen, and I just noted it down as is. The following: banks should actually give loans to people who really need it, but in fact, they give it to people who can prove best that they do not need it. So that's a kind of contradiction, that in order to get your consumer credits, you actually have to prove that you're credit worthy. But on the other hand, the people that need it most, of course, for consumer credit, it is a little bit debatable if you really need it. But if you apply it to other lending cases like mortgages and so on, probably the people who really need it are not the people who are most credit worthy. So there's like a contradiction there. And then it's to be debated whether it's unfair to deny such a loan to somebody who is actually having a low credit worthiness. So that's very tricky. Also, the idea was also that typically the decision is made on giving a loan or denying a loan in terms of modeling. But what about if you have a higher risk? If we can build a model that accurately predicts your risk of default, can't we have like a more inclusive credit scoring system that will allocate higher interest rates, or like Caroline, as you said, extend the duration so that the customer can still be allocated the credits, but he will get a higher risk. So he will get a higher interest rates. However, what Koen said is that typically banks don't do that. So typically, if you're in the top tier of bad credit risk scores, you will not be granted any loan at all, even not at very high interest rates, because you need to be with enough customers to secure that they will actually be able to get the money back. So there's also the number game that comes in there. That brings me to the last question. We didn't debate too much on that. So which variables are fair to use? We basically said that age and job housing are somewhat correlated. So it's debatable whether you can use, whether someone rents a house or whether they own a house, because if you're too young, you probably will not own a house. So that was a question we had. We also said that it should be more focused on real creditworthiness factors such as your financials and payment history. If you translate that to this use case, it would mean that we focus on the savings and current accounts variables, but not so much on, so we had age, we wouldn't use gender, we wouldn't use job, probably also not. And there was a fourth one, which I forgot, sorry. Okay, and in general, there's like an issue that the credit consumer legislation indicates that you should monitor certain unfairness with regard to groups, and that you should monitor consumers that are potentially over-indebted. However, since that if you can prove, for example, that the business impact of being over-indebted is correlated with is actually having a bigger business impact when you're older than when you're younger, it would make sense that you would be allowed to use age as a variable in that specific case. So it's a little bit a question of when can you use certain variables. So maybe for older customers, as they are beyond a certain threshold, maybe then it's worthwhile to have like a separate model for those people, because you know they have a bigger risk.
The other way, actually, you can discriminate towards, you have several banks who have been convicted almost, I think, because they targeted credit low groups. So they sold credit cards with very high interest rates to people who could not get credit approval anywhere else. So they knew, let's target them. And I actually saw it because I was in a law firm at Porte Namur in Brussels, next to Matongo. You had a shopping mall with almost 3 shops out of the 20 place. So it was really like empty. And there, every day, there was like this little stand of a bank, a well-known bank, who sold credit cards to people passing by. So you can indeed target specific groups to sell your product to them, because you hope that you can, by being very aggressive, you will be able to make a profit out of them. And then we also come to the question, can you ask a higher interest rate to higher risk customers? That's exactly what they did, actually. So sometimes it does happen, but it's not in favor of these groups, because they will be pushed into very high loans, and they will go down.